Hi, I'm Rob.
And I'm Rob.
And this is Ask Rob and Rob.
Hello everyone and welcome to Ask Rob and Rob, the show where you get your questions in, quite often property related, and we give you our answers. This week will be no different, but what is different is I'll be going home for the first question, so that's quite exciting. But before we get to our first question, let's remind you of how you can get your question in to the show.
Yeah, dead easy. All you've got to do is call 013 808 00035, or if you prefer, you can go to propertyhub.net/ask and use that newfangled internet thingy to send us your question instead. Either way, it's all good, and you'll get your question answered just like Rachel is about to now.
Hi, Rob and Rob. Firstly, thank you so much for all of the free content that you put out there on social media. It's really helped to build my confidence in potentially buying my second buy-to-let property in the near future. So as it stands, me and my brother own a buy-to-let property in the southeast, which we currently rent out, and there is a mortgage on that property. However, we're now looking to purchase our second property in the north of England for cash. We have found a property for £65,000 in Kirkdale, Liverpool, which can potentially give us an annual rental yield of 8.31%, which we're quite happy with. However, I've just seen on one of your Instagram stories that you would advise buying a property that is worth £100,000. Do you think this would be a better way for us to use our £65,000 in cash, maybe as a deposit, and then buying a property with a mortgage? Or do you think it is okay to buy a property that is a little bit cheaper with cash? Thanks very much.
Well, and an 8% plus yield is going to be very attractive. What you have to be cautious about, though, is buying a property for £65,000, not just in Kirkdale, but anywhere, because £65,000 properties generally, and this is me being generally, don't do as well when it comes to capital growth. And in a boom market, when they do go up in value, they are the properties that tend to crash the hardest on the other way down. So you may see some growth over the next few years, but then when the market takes a turn, it's a little bit way off yet, but when it does, you'll be hurt a bit harder. Now, what you'll be cushioned by, hopefully, is a nice yield throughout. So, should you go ahead? Because you've made a point, you've offered an alternative, which is you buy this property for 65k cash, or you use that as a deposit and leverage. So let's say with that 65k, you can buy a property worth 200k instead. 50k down and then the other 15k for costs. Is that a better option? Well, I think it's worth saying that the chances of it being an 8% yield are reduced, and reduced by quite a bit. You might be lucky to be getting, and I'm assuming these are all gross yields, you might be lucky to get a 5% gross yield. So therefore it makes sense to go for the 8% yield, right? Well, maybe. But there's a few things you need to do here. A gross yield is a good indicator to use when you're doing an initial assessment. But what I would do next is look for my return on investment. So a gross yield isn't your return because there's going to be costs involved. Now, if you're buying cash, you don't have a mortgage, but you still will have some running costs. And with the 200k, you will have a mortgage and some running costs. And work out your ROI. So what you left with versus what you put into the property. If you're not familiar with return on investment and equity, then just do a quick Google search and it'll give you more information. But rent aside, I think there's a very strong argument for using a mortgage. And there's a lot of reasons, but I'm going to give you two. The first reason is that if your property goes up by 10%, now at current levels, that'll take about a year, whether it takes a year, 2 years, it doesn't really matter. But when it goes up by 10%, your property in Kirkdale would have risen by £6,500. Nice. But your property elsewhere for 200k would have risen by £20,000. So 3 times as much. That's a big, big difference. Now, the profits that you end up with on these properties after all your costs might be the difference of £100 a month, possibly. A couple of £100 a month even. But let's say it's a couple of £100 a month. That's £2,400 over the year. It's going to take you a lot of years of rental to get to the same level as the capital growth gains you would have made. So the leveraging really allows you to take advantage of capital growth. But the second reason I'd give you for considering using a mortgage is inflation. Property prices go up. And a big part of that is inflation, particularly in a boom market. But at the same time, your debt is eroded by inflation. So the real-time value of that debt, that 150k mortgage that you'd have, will be getting eroded. So inflation is your friend when it comes to property investment because it reduces the real-term value of your debt and increases the asset value. So there are other reasons, but for those two reasons alone, it's seriously worth considering using a mortgage to invest in property. So it seems that our next caller is interested in inflation as well. But this person hasn't given their name, Rob. So what would you like to call them?
Well, let's have a listen to Kenneth.
Hi, Rob and Rob. I'm loving the podcast. I must have listened to the episode on quantitative easing 3 times now. It just seems so significant. If we are heading for a period of inflation in the future, and governments often control inflation by rising interest rates, does that mean we're going to see mortgage rates go up in the next few years? I was wondering what your guesses and predictions might be for mortgages in the next few years. Thanks.
Ken, how long have you got? You've got me onto one of my favourite subjects here. Yes, you're quite right to go back and listen to that Kiwi episode because it is such a big topic, and you're right to be thinking about inflation and interest rates as well because, like Rob said, it's such a huge factor for good or bad when you're thinking about property investment. So your question is a very sensible one. If we are heading for a period of high inflation, does that mean that governments are going to do what governments in theory should do and have often done in the past, which is increase interest rates to control that inflation, and therefore the cost of your mortgage will go up? Logically, that makes complete sense. There are a couple of reasons, though, why that might turn out not to be the case. The first of those reasons is that, as we've said before on the podcast a few times, the relationship between the base rate and mortgage rates is not necessarily a direct one. In other words, if the base rate goes up 1%, it doesn't mean the cost of mortgages will go up 1%. It might do. But if lenders are in the mood to lend and they're trying to take market share off each other, then they may well absorb some of that and just make smaller margins themselves. Lenders' margins are pretty decent at the moment, despite mortgage rates in general being so low. So it may be the case that the base rate goes up, but mortgages don't. The other reason why the situation you've outlined may not happen is that, as we touched on in the inflation episodes we did recently, you should definitely go and listen to those if you haven't already, is that I don't believe the government has really got much interest in controlling inflation. Why is that the case? Because they need inflation to inflate away their own debts. And they also don't want to put up interest rates because it's going to increase the cost of their own borrowing, which is enormous. So if they really did want to control inflation, then yes, they'd put interest rates up. But inflation is actually helping them out, and putting up interest rates would really not help them out. So it's possible that they will decide to be relaxed about inflation and allow it to continue for as long as they can. And that's backed up by some of the noises coming out of the Bank of England at the moment. So for a few months, the Bank of England was saying, oh, don't worry about inflation. It's only transitory. It's probably not going to really be a thing anyway. But then there's data that's come out saying that inflation is likely to rise towards 4% towards the end of the year, compared with their previous estimate, which was 2.5%, which is quite a long way off, by the way. But what are they doing in response to inflation getting to double their target and then seemingly going on from there? Well, in their last meeting, they agreed that the conditions had been met to start discussing raising interest rates again. So not doing it, but starting to talk about doing it. And that was with inflation running far higher than it should be by their own target and far higher than they thought it should be. So they're starting to think about maybe talking about it perhaps. And when they do get around to doing it, they're still talking about doing very small increases in rates. So they're talking about the potential of a 0.25% increase next year before rates reach 0.5% in 2024. So we're definitely not talking big numbers here. So that turned into a little bit of a rant, as it was inevitably always going to. But to actually answer your question, does that mean that mortgage rates are going to go up in the next few years? Well, possibly. Even probably, because mortgage rates are really low right now. And when you're buying, you should always factor in the possibility of rates going up. In reality, your new borrowing is going to be stress tested against a far higher rate of borrowing anyway, so you can't get yourself into too much trouble. But I think you can be reasonably relaxed about rates going up dramatically, but also not hesitate to secure a mortgage now, because rates really are very good. And if you've got the right property to spend the funds on, then there's not much to be gained by waiting.
And Kenny, remember, if you are still really worried, even after all that reassurance, you can look at getting yourself a 5-year fixed mortgage. You know, that'll protect you for some time into the future. 5 years, precisely, in fact. And although you'll pay a little bit more for a 5-year fix, because mortgage rates are so low right now and the lenders are competing for your business, probably surprise you how cheap you can get a 5-year fixed mortgage for. So consider that as an option as well if you're still worried. But as Rob has talked about already, there doesn't seem any immediate appetite for rate rises. So We'll see what the medium term brings, but the short term at least suggests that there's no change on the horizon. And there's no change on the horizon in terms of our schedule as well, because on Thursday we will be back with the Property Podcast. And of course, next week we'll be back with Ask Rob and Rob. So until then, take care, have fun, bye-bye.
Bye-bye.